Let's welcome in our next guest on the show. We have George Heber Joseph, Chief Investment Officer and Chief Executive Officer, Equity at ASK Investment Managers, joining in. George, great to have you back with us here on Moneycontrol. Thanks for joining in. So I think the global headlines, the war and the geopolitical headlines. Hi. So I'm saying the war headlines have thankfully settled. Monsoon is picking up. So I think now the market's attention is going to be entirely on the numbers, on the earnings, right? What have you made of the recovery and the way we're approaching this earnings season?
Very interesting time. If you look at the macro numbers have improved substantially in the last 20, 30 days. And I was just looking at, have the FI flows improved to the emerging markets? The answer is yes, which is very good for large caps. And also the biggest challenge what we have been seeing is that MSCI rebalancing, we are losing weights for India consistently to Korea and Taiwan. That is also more or less settled down and, it's coming back. The macro situation specifically with regard to credit growth, also with, the PMI numbers, all of them looking good and double-digit credit growth consistently for the last couple of months, which is also very interesting. So which bodes well for banks. So monsoon, I was looking at the latest update. As per the data, what it's IMD data, what it's clearly suggests is that 40% gap has come down to 24% now. Actually July is surplus, June was a deficit. So which is again, looking very interesting. Oil price behaving well, it has come off quite sharply, which was the biggest concern in the last couple of months, because of which the current account deficit, as well as the inflationary environment, we were all worried. Even though 3.9%, the inflation number, which was higher, but still within the RBI limits. So overall, looking very interesting. But mind you, in next couple of quarters, the energy impact which would have had to the company's numbers will be visible in the earnings numbers. But this is the time to look through these earnings season and say that, okay, all the other factors have improved, global as well as macro factors and domestically improved. This is a time to increase the beta exposure. So we are quite constructive on the markets. We like banking sectors specifically, the private banks, which has been beaten down to dust for the last 5 years, looks very, very interesting. Overall, banking and financials will be one of the biggest overweight for us, followed by other cyclical sectors.
Okay, so you like banking, but George, let me just understand this. Are you saying this is the time to go big on mid caps? Do you see momentum coming back in the market, or is this still going to be a very, very selective market, mostly large cap driven?
It is going to be a very selective market, but at the same time, mind you, for the last couple of years, India has lost humongous money from FIIs. FIIs were only in a selling mode, and they were predominantly owning large caps. So our view is that, this is a point where the large caps can start looking interesting. And, some color started happening from the last couple of weeks. And you will see more and more participation towards large caps because, 5 years, most of the large caps have not generated any return for investors. Most of these companies were making only profits. So it is basically PE derating or price to book derating was happening for these companies. And whereas mid caps and small caps have done reasonably well. So when I look at from the valuation perspective, 2.9 times price to book, large caps are we are getting right now, especially Nifty 50 companies, which is one of the lowest points in history, apart from COVID times or global financial crisis times. So it is one of the interesting times. And when you look at the valuation gap between large, mid, and small, one of the lowest point large caps are available in 20 years. So very good time to catch some of these blue chips because they have not done well. They're making profits. Now the sentiment is improving with regard to the FI money coming back, even either through the ETF route or otherwise. So very good time to look at large caps and mid and small caps. Obviously, it was buoyant because of mutual fund money flowing mainly into mid and small cap space through either through flexi cap funds or mid cap funds or small cap funds. So very interesting time in my last 25 years of workex. I'm seeing this as one of the most interesting time in markets. On one side, micro caps beyond 500, top 500 companies are looking very, very attractive. Top 50 companies are looking attractive. In middle is where the valuation is significantly punchy.
Okay, so yeah, you're absolutely right. I take that point. Either you find the undiscovered so-called hidden gems, which will be buried lower down the market cap curve, or you stick to the pristine blue chips. The middle is where the problem is. Interesting point, and point well noted, George. So okay, let's talk about what all you're liking in the market in terms of themes and sectors. You mentioned financials. So what part of financials, banks, non-lenders? It's a very wide universe now. Tell us a little more.
So we like lenders, non-banking as well as banking counterparts. We like very, very clearly. So large banking institutions, because mid and small cap banks have done reasonably well in the last few years. Most of the mid cap banks, which you would like to buy, all of them are trading at one of the highest valuation point. Even small cap banks have done reasonably well. Only the large banks have not done well, mainly because the credit growth was not visible. So last 5 years, I would call it as more of a recovery play. The large some of the large private banks as well as PSU banks and the small banks were having the maximum NPA 5 years back or 6 years back, right? So that has mellowed down, and most of them are having pristine balance sheet at this point in time because the sectors to which they were catering to, all of them recovered, be it real estate, capital goods sector, engineering, and also the commodities. All these recovered, and therefore it was more of a recovery play. So all the banks NPAs got clearly, recovered. Now is the time where the credit growth started happening. That's where, men versus boys, you will be clearly visible. Which are the banks which can underwrite very well, and that's where some of the large private banks will come back strongly. And plus the FCNRB deposits gathering, which is happening at this point in time, which also puts a lot of positivity around some of these large banks which are capable to raise FCNRB deposits abroad. So the good part is some of these companies where we were worried about valuation, whether it will stick around because the growth was not visible. Now the deposit growth as well as the loan book growth will be visible for these banks, and because of which it will be very interesting time to own these lending institutions. At the same time, inflation worries as well as El Nino worries dying down. The NBFCs also will come into the radar. So banks and financials obviously is a preferred pick. Then when we look at the biggest story happening around the world is on data center and AI. Even though some of the AI chip stocks might have already peaked out, but the data center story is still gathering momentum. And most of the Indian companies are poised to benefit out of it through the capex and electrification and transformers as well as the EPC. That's where a lot of opportunity which we see, and some of the large MNC names as well as some of the mid and small cap in this space looks very interesting. Defense is another pack, which is a long-term theme, still continues, which looks interesting. And China plus one manufacturing theme we like a lot because when we look at some of the pharma majors or pharma companies, they are getting orders from abroad, and they are setting up capex, huge capex also. So we like a host of companies in the manufacturing space as well.
Yeah. You mentioned the data center theme and, of course, the related power plays. And I just want to mention all these stocks that fell on Friday. The buy on dips is really playing out so quickly on them. Look at Hitachi Energy. It's up about almost 4% now. Power Industries 2%, GE Vernova T&D 2%, CG Power is up 2% as well, BHEL. So the entire pack has jumped back really, really quickly after a big slide on Friday. What about valuations, George? You mentioned that in some of the beyond the nifty stocks, the large mid-cap space, right? That's where there is a valuation problem. Do you see that with these stocks, power equipment makers?
Yes, yes, so the valuation is punchy, but we have to look through the cycle. This is where some sort of past experience will help, because when you look through different decades which has happened in the past, like 1990 to 2000, say for example, take an example like a Wipro in the dot-com boom, it has become almost 700 times, and the valuations came, from 10 PE, it went to almost, 300 PE, right? So the challenge is that, when we see the cycle is on, the capex cycle in the data center space is massive. All the global majors are putting, as well as, some of the Indian counterparts is also working on it. There is a very high probability this cycle can be long drawn and, can be very rewarding for investors. So you have to look at some of the global competitors, how are they placed and what are they talking about? When you look at GE Vernova, the name you mentioned, if you see the global presentation, they are talking about stock outs till 2028, 29, right? So there is a good amount of opportunity coming up. We have to look through the cycle and see that, what kind of order book with these companies can get over a period of next 2, 3, 5 years, and which all can fire through. That's where the biggest benefit can come. This we have seen in the years like 2010, 2000 to 2010 period also, when the entire China-led growth was visible and global consensus growth was visible. We have seen this kind of order book growth. So that is the phase we are in. So cyclical sectors specifically leading to these, we'll be very positively looking at it. Yeah, what you said is right. Sometimes it looks expensive. You have to buy, wait, and look for opportunities to buy into.
By the way, the other sector that George briefly mentioned, defense, which he sees as a long-term opportunity. A lot of defense stocks are doing very well today. Perhaps it's the excitement of the Defense Acquisition Council again approving a bunch of projects. So look at Zen Technologies, 5.5% higher. Look at Paras Defense, 4%. BEL from the large cap space is higher. Idea Forge, 4.5% higher. So a lot of these defense names are now popping up on my screen, looking fairly interesting. Let's get the defense names up. And BEL is the bigger one, and those are some of the mid-cap names that are doing pretty well. George, what are you buying in defense? Because again, it's a very diverse pack, from aircraft manufacturers to, the mid-cap, component providers that are part of the assembly ecosystem. There are, of course, auto companies that are also now getting into aviation and defense. So it's a large sort of growing sector. What do you like here?
So we like across board, we look at from a stability perspective, some of the large caps, government companies are very interesting. And also defense assets, it is bit, very, very difficult to enter business, right? It is not easy to enter, and also to get the order book outlook is very difficult. So for the large cap companies, some of them are very cheap right now because of the sell-off and all those things, which looks very interesting. The names which you were mentioning, some of these are in the mid and small cap, the component manufacturers are looking interesting. The other area which, I like at this point in time, and where I think the market is not giving much value, or, the market caps, but the long history of outperformance as well as multi-bagger could come, is from the agrochemical space, which looks interesting. There are small caps, mid caps, which you can look into, which is not done well for many years, but it is coming out of a lull period with the management changes and so on and so forth. So there's a very good bet that you can make in the agrochemical space, which can potentially become large companies over the next 5, 10 years. So that's one space where we have invested heavily in our portfolios, which looks very bright to us.
Okay. All right. A lot of ideas there, George. Good conversation. Thank you for giving us, a lot of food for thought, and for our viewers to go back and do their own homework. around some of these themes. Good to have you on the show today. Have a great week.
Thank
and
you.
Thank you for
Thank
joining.
you. Yeah, same to you.
Okay. All right. That's a view from ASK Investment Managers. By the way, let's